Hello everyone, Elliot Gu here. I'm co-founder of Capitalist Times Investment Research and the Free Market Speculator. Today I want to talk a little bit about a very interesting investment theme that I think has a lot of opportunity over the next few years. And specifically, it's in an often overlooked and sort of underappreciated sector. Now, I wrote extensively about this in the issue I sent out yesterday, but that was a very long issue and I think it might have gotten actually lost in the mix. So I wanted to sort of bring attention to it, tell you a little bit more about it in this quick video. The other thing is the stock we recommended is in the agricultural industry. So I'll tell you a little bit more about why I like that here in a minute. But I think oftentimes a lot of people look at agriculture and they say, you know, that's kind of boring. In fact, I was talking to a friend of mine the other day about this stock, and I mean, you could see he just wasn't very particularly interested in it, even though he's a very experienced investor. So I think it's a sector that often gets overlooked, and I think a lot of people assume that returns in the agricultural sector aren't great. But I can tell you from personal experience, that's absolutely not the case. So this first chart I'm going to throw up here on your screen is actually a chart of a fertilizer company. It's a company called Mosaic. The symbol is MOS. This is not the stock I recommended in the issue yesterday, but I want to show you this for illustrative purposes. The last time we reached a real bull market for agriculture was back about 20 years ago in the early 2000s, somewhere around 2002, 2003. And back then I was recommending this stock in a number of different newsletters that I wrote for, a number of different services I published. In fact, I wrote about it in my book that I co-authored, The Silk Road to Riches, which was published back in early 2006. And Mosaic, as I said, it's a fertilizer company. This is not some fly-by-night tiny little company. This is the largest producer of phosphate fertilizer in North America. It's actually headquartered right here in Florida. Phosphate is a fertilizer produced from rock. It's actually a mined rock, which is very common here in Florida. And between 2003, Mosaic was trading around $4.42 on a dividend and split adjusted basis. By the peak in June 2008, it was trading over $114 a share. Now that's a 25-fold gain over a period of less than 5 years. Now, tell you what, that puts NVIDIA to shame, right? And a lot of these other tech stocks that have sort of captivated the market's attention in recent years. Now, why do I like agriculture? Why do I think it's such a great opportunity right now? Well, it goes back to the great cycle theme that I've been writing about and talking about in these videos a lot here over the last few months. And the idea is really pretty simple. Go back through history and you'll see that there are prolonged multi-year periods where US stocks have beaten every other asset class out there. So towards the end of these periods, the stock market tends to get very highly valued, very expensive in the US, and you start reading and hearing about how US exceptionalism, everybody wants to invest only in the US stock market, in the S&P 500. We saw this in the late 1990s, back during the tech boom of the late NASDAQ and tech boom of the late 1990s, centered around stocks like Cisco. The CSCO, that company, was huge, a big winner in those days. Qualcomm back in those days was another big winner. Now you can go back to the 1960s, the late 1960s, and it was the so-called Nifty 50 stocks. So these were big American companies, considered growth companies, and they were thought to be one-decision stocks, right? Stocks that you bought and held forever. And there's a list of roughly 50 of these names that were pretty much in everybody's portfolio, very popular investment vehicles of the day, much like NVIDIA or Microsoft or a Meta or a name like that would be today, these magnificent 7 stocks today. Now, as these periods draw to a close, you see a big shift, and it hurts a lot of investors, right? And it's a shift away from the US stock market. Valuations come down. And what works in this phase of the cycle, this part of the cycle, is commodities, right? Commodities tend to go up a lot in price. We saw that in the 70s, of course, and we saw that in the 2000s, right? Between the late 90s and the early 2010s. So commodities work well. The dollar is generally weak. Foreign stocks often beat U.S. stocks, at least some foreign stocks. We certainly saw that in the 2000s. And I believe we're entering that part of the cycle right now. In fact, technology stocks have been dramatically underperforming the S&P 500 since last summer, since the summer of 2024. And foreign markets are dramatically outperforming the U.S. market so far in 2025. We've seen the dollar weaken considerably as well. And some commodity markets are taking off. Precious metals, for example. I believe agriculture has to be part of that conversation. Now, let me show you this chart. This chart is, I think it's a fascinating chart. It's based on a data set that I've talked about, before in this service, which is based on a report that came out of Deutsche Bank back in 2020, which is long-term asset returns by decade. And they actually provide data on returns from various assets, stocks, government bonds, various commodities, right? Going back well over a century, back to the mid-19th century. So this chart shows nominal annualized returns, so that's not adjusted for inflation, for 5 different assets by decade since 1850 to 1859. All returns are in US dollar terms. Now, equities are represented by the light blue bars on my chart. Now, take a look at the period from 1950 to 1969 that I've boxed in a black rectangle here. Over this 2-decade period, U.S. equities outperformed, and commodities offered little or no nominal upside. Indeed, wheat prices, which are the green bars in this chart, actually fell in nominal terms through this period, while the CRB index as a whole, that's the Commodity Research Bureau, what used to be called the Commodity Research Bureau Index, it's an index of a lot of different commodity markets combined. So precious metals, oil, energy, right? Generally. Also, agricultural commodities are in there. Base metals like copper are in there as well. So the CRB index as a whole in the 50s and 60s only offered a slight positive return for both decades. Once adjusted for inflation, both wheat, which of course is a major agricultural commodity, which we have data for going back to the mid-19th century, and the broader commodity complex actually offered negative real returns in both the 1950s and the 1960s. So stocks performed well, commodities did not, agricultural commodities did not. But look what happened in the 1970s. Equities offered a 5.77% annualized return from 1970 through 1979, which totally disappears and then some once you account for inflation. On an inflation-adjusted or real basis, equities actually had a negative 1.15% annualized return through the 1970s. Commodities were the only source of real wealth creation in the 1970s. On a nominal basis, the broader CRB index rose about 10.5% annualized, while wheat returned 11.43% annualized. Gold prices were up 30.7% annualized, and oil, which I haven't pictured in this chart because I thought it might get a little bit too busy if I did, they jumped over 28% annualized in the 1970s. Then, once again, as you can see in the same chart, equities took over from a return perspective in the 80s and 1990s before commodities jumped once again in the 2000 to 2009 era. Go back even further on this chart and look how these cycles have played out over time. This is not, I repeat, not a new phenomenon, right? In the 1850s, equities produced annualized returns of just 1.62% on a nominal basis and 0.07%, basically flat in real terms. Meanwhile, wheat returned 5.7% annualized. Equities then boomed in the 1920s while wheat, copper, and the CRB index fell. Now, of course, financial markets are inherently noisy. These cycles don't always match up to one another. In other words, gold, oil, and wheat aren't all going to necessarily bottom in the same years. But over these multi-year periods in time, such as we saw from the late 90s really up until the early 2010s, back in the late 1960s to early 1980s, back in the 1850s, right? You have these prolonged periods where commodities generally outperform stock, alternating with periods where stocks generally outperform commodities. I believe we're now clearly in one of those periods where commodities are going to outperform, and stocks, even if they don't fall outright, are going to produce small much smaller returns on an average annualized basis over the next 10 years or so than they have over the past 15, 16, 17, 18 years since the great financial crisis in the late 2000s. I think agricultural commodities are going to be one of the big winners on this basis. Now, one of the things I like to talk about and do with agricultural commodities, and you can kind of see it on that chart I threw up a minute ago of Mosaic, right? They tend to be kind of sleepy markets for long periods of time and then kind of really take off, right? We saw that in Mosaic between 2003 and 2008. And so the time to really look at these stocks is when you think they're near the bottom of the cycle. And what we've seen in the last few years is agricultural commodity prices, wheat, corn, soybeans in particular, were all up a lot in 2021, 2022, after having been very weak in 2020. So we saw these markets really come alive. But since late 2022, most of these markets have pulled back. The two most important agricultural markets here in the U.S. are corn, number one, and wheat and soybeans, number two. Wheat, not a particularly important commodity in the U.S. The reason I included it on that last slide is we have data going back on it a lot farther. Recently, corn prices have been outperforming soybeans a little bit. Now, this is important because if you're a U.S. farmer here in North America, even anywhere in North America, you really do have somewhat of a choice, right? You can plant more acres in soybeans, or you can plant more acres in corn. And so you're going to tend to make that decision, the swing there, how many acres you plant in corn versus how many acres you plant in soybeans, based on prevailing commodity prices. So the fact that corn has been outperforming soybeans very lately means that we are seeing a shift in favor of corn acres planted this year. Now, this chart here is a chart from USDA. This is Planting Intentions Report. It came out at the end of March this year, so about a month ago. And what it shows is we're looking at historical data there for the U.S. in terms of millions of acres planted in corn in the U.S. and millions of acres planted in soybeans. So corn is in blue and soybeans is in orange. And you can see significant variation there. For example, in 2023, because of the big rally in corn prices in 2022, as I talked about, you saw a big jump in the number of acres planted in corn. And that's part of the reason why corn prices got very weak, right? They were up over $8 a bushel back in 2022, down under $4 a bushel at one point last year. This year, though, because corn prices have been improving, the USDA is actually projecting, which I show you with that black arrow there, a big jump in corn acres planted from a little over 90 million acres last year, upwards of 95.3 million acres is their estimate for 2025. At the same time, soybean acres planted is falling. Now, what does that mean? Well, it means that I believe this year you should focus on agricultural stocks, right, that benefit with more business related to corn than soybeans. As I said, those are the two big cash crops. So you want to look for a stock which has more exposure to corn volumes planted, right? Agricultural inputs related to corn than to soybeans. So I'm not going to tell you the name that I recommended in the issue just yesterday because I just recommended it yesterday. I don't think that would be fair to paid readers of the Free Market Speculator service. However, if you'd like to check out more about what I see going on in the agricultural markets, where I think some of the opportunities could be, and even take a test drive absolutely free of the Free Market Speculator service, where of course I reveal the name of this recommendation and actually another recommendation I made in yesterday's issue, then I'll throw the link down below where you can check that out. This is a very large theme for me in the Free Market Speculator, really across all the products that we publish, and it's something I've talked about a lot here in these videos, as well as in the free and paid services that we put out. And so, for example, we talked about precious metals a couple of weeks ago, talked about energy, of course, and I actually have revealed some of the names we recommend there. Because this particular recommendation is so recently, I'm not going to tell you what it is right here, but again, it is available for a limited time for free, absolutely free, as part of a test drive of the Free Market Speculator service. I really think it's important, though, to call attention to the agricultural theme because it gets lost in the shuffle so much. People talk about a commodities bull market. They focus on oil a lot, gold maybe, silver even, natural gas even. Agricultural commodities get left in the rearview mirror, but the truth is that in some periods of time they produce spectacular gains, far greater than what was available in oil, gold, or any of these other commodities that get a lot more attention. So I wanted to call that to your attention. Keep it in mind, and please check out the link that I've dropped below for more on this theme and others we cover in the Free Market Speculator. Thanks for listening. My name's Elliot Yu. I hope you found this useful. Talk to you soon.